Welcome to the review and overview introduction to RAIDER12, which is a really cool new system we've discovered and then developed. It's a new strategy, a new approach we've discovered and then developed into this system. And it's one of our favorites now. And it's something that I would definitely suggest you learn. This concept of using a strangle is pretty cool with NADEX. You just have to know where to place these things, and you need the trading math to work out where your frequency of just getting that out of the money scenario into the money just simply works out. And the great thing is when you're going out of the money, and depending on how far you go out, but when you get the big reward to smaller risk, okay, then you don't need to win as often, right? So there are different ways to do strangles, but we're taking the out of the money approach. We're looking for, a big move, and we're looking to actually use the daily binary. And so we have this way of trading that's pretty simple. It's pretty easy. Doesn't take a lot of time. We put this thing on. I mean, it sounds kind of idealistic, and it is. I would say that this is the type of approach that it's a lot of people look for. Okay, I mean, I hate to say, push button type of easy, right? Like mindless caveman, not caveman. I don't know if a caveman's mindless. Caveman's. You say it's more direct minded. How about that? See do, right? See do. That's great for systems trading. Okay? The more simple minded mindset is good for systems trading, right? See do. Don't think too much. Don't get too fancy. Don't get enticed by some emotional thought, and just simply do your system. Okay, so hey, that's what this is. I mean, that's what a system is. That's why we design these systems. You just have a method that you can just see and do. I mean, hey, if you can stick with a system, of course, you have to prove the system to yourself first. How do you do that? Historical study. Then you can do historical paper trading. Just shove the chart to the right and just go little by little and react, and so on. I mean, of course, you have the demo, but you're going day by day. That's going to take a while, but that's good to do. Start doing right away, because you're going to notice things, and you may find new ideas for yourself. You may have new discoveries. Okay, it may trigger some new ways, new approaches that you like that fit your personality better. But this has its own value, and you may just like doing it as is. Let's go take a look. Now, first of all, what's a strangle? Some of you sound scary, right? Like strangle. Okay. Now, what the strangle is it's an vanilla option strategy. Okay. A strangle comes from the vanilla options world, which NADEX uses in its chains. Okay. NADEX mixes a vanilla options type of pricing model mixed with a binary option, as you can see, if you just look at the chain and see how it behaves. But it's very unique. I mean, they do a lot of different things. It's not just like vanillas, right? But it's a lot like vanillas. And you can do strangles. That means, okay, so you've maybe heard of a straddle, okay? Straddle, where you're going to play both sides of the market. And a straddle lines up at the same strike, okay? A strangle lines up at different strikes. Okay, so you're coming from the outside in, all right, we'll just leave it as that. So we're looking to come from the outside in, and then with the binaries, though, we're looking to either take an outside position into the money and then just grab the profits and run. Okay, maybe we can ride this thing up to 50 or 60 even, and say, hey, I'm happy with that. I just made a big return. I'm out of here. Okay. Or you can, you may get the momentum to take it all the way to 80 or 90 and just say, hey, good enough for me. See ya. And just take it like that, or just let it expire. I mean, during the day, you can go one way really hard in the morning trend. And since we're playing both sides of the market, it doesn't matter which direction it goes, right? That's a great thing. We don't need to pick the direction. So we let it go. And then, but very often you can see a reversal right back up the other way. Okay. So sometimes, first of all, on the negative side, you waiting for expiration, you may have been able to take out a position at 70, 80, 90 or whatever and capture that very large return. Okay, let's say you have a strangle that you're going far out of the money. So you put it on at 10 or 15 or something, or 12 or whatever on the buy side. Okay. Sell it at 90, 85, 88 on the sell side, right? So, and you ride the momentum, and then you can capture it because because you have day trading experience, you realize, hey man, this trend went hard, and I have the money right here. Why wait to expiration, right? Just take it. And you know what? If you wait to expiration, it may expire between your strikes, and you lose what you put in, right? But on the other hand, you could potentially even take your profits on one side and then have the instrument go back up the other way and even potentially expire you in the money. Or you can ride your position. Okay, let's say it even gets to at the money, and it goes from, let's say you bought it at 12 and it bounced back up and now it's at 50. Well, you can get a lot more money, okay? Especially if you expire in the money, then you can have, quite a amazing return in one day. All right, so these are different pictures, and but so it's real systematic approach. We have to have our math right. We have to have our probability. We have to have our percentages line up, and we just have to be able to simply flatly put the position on and have it happen. Okay, and now have it happen doesn't mean you're going to win every time. In case you have a biz op mindset out there, because I'm seeing it. I already heard someone ask about it, and you want to do a real trading business, okay? You don't want to have this pie in the sky type of weird brain fried mentality that usually comes from bad marketers out there that say, oh, you can push this button. Actually, you don't have to push the button. You can think about pushing the button. Yeah. And then you'll just get all this money, and you don't have to do anything. You can go to the beach and buy a yacht and whatever else they say, right? We've all been through that. Yeah, I don't know if we all, hopefully you haven't, but don't go through it if you haven't. So brain fried stuff. So it's a waste of time. So anyways, you can look at the different instruments. This may work well on differently on different instruments. So for example, here's a comparison. We have U.S. small cap versus U.S. tech, okay? And you can see here, when you win, here's the ratio, and which is what we're targeting, okay? We were targeting entering at 10 on each side. So when you lose, you lose. With the sample here, okay, of 18 days, okay? It's only 18 days, right? 18 days, not 18 months, 18 days. So 14 wins, 4 losses. Now that's great for a strategy like a system like this, okay, that's going, for out of the money. This is probably more what we would expect, like actually, no, that's even more losses. But I put this up here too because this shows the math. Okay, we don't need to have a good winning percentage. Of course, we'll take this, right? I'm sure you'll like this. Or you can go check out other instruments. They may do well too. You remember NADEX prices their strikes differently. to different instruments. They try to fit to a variety of factors in terms of their pricing and their deltas and their strikes. They price out throughout the various strikes up the chain, right? So but you can see the difference here. Okay, now this US tech sample was for 2 months as well, so you can see here. It's a little confusing stated. So when you lose in this example, you have two. So let's say you bought it at, I guess we're using the example, you bought it at 12 and you sold it at 88. So your combined loss would be, well, actually you only lose one side. If you lost the whole position, then you would lose, you know what? We just corrected this. This was not put out here very nicely, very accurately. So just corrected this. This was pretty much right. This, we didn't consider the both sides. So instead of 122,000 net profit, it's 118,000 net profit. Okay, so so we added some more text here. Hopefully it's more clear, because it really wasn't very clear before. So anyways, let me just explain this a bit more. All right, so you have 4 losses. Okay, if you're buying at 10 and selling at 90, you have 2 sides. So you expire in the middle and you just don't take any profits beforehand or whatever. And so then therefore you lose on both sides. And then if you have the position at 10 and sold at 90 for this example, you can see here, okay, that would be $2,000 loss on 100 contracts, okay, and or a $20 loss on 1 contract, right? You don't have to do 100 contracts or 1,000 contracts. You can do 1 contract, okay? All right, so now 8,000, and then now on your win side, if you're winning with 100 contracts and expiring in the money, so let's just pop on over to the change just to give you a picture here in real time. So you can see here, so you put on 100 contracts, max profit. Well, let's go to limit order. If you put on 100 contracts here you can see with the limit order versus the buffer they put in with the market order, you can see here max profit 9,000, max loss 800. Okay, so this is buying at 8, and then you can just play around with and have NADEX figure out the math for you. Okay, that's just the easiest route. Okay, so I'm back to this example. Here, so on the win side, you win 14. Okay, this is 18 days here, and then so that you net out $118,000. Okay, so you subtract the revenue minus the costs. Okay, now that's nice, 18, and we won 14. But here's a good example too, because why is this a good example? Even though it actually lost more than you win, and okay, I think I mentioned already, some pairs may perform better consistently just due to the price behavior or the character of that instrument. Okay, so, and character of the instrument, character of NADEX pricing in coordination with the instrument. Okay, so you can see here you have 15 wins and 23 losses. This is 2 months now, so it's a little over double the results there of this performance example. And you can see now when you lose, going out of the money, you lose in $2,400. Okay, we took it at 12 on each side. You buy at 12, sell at 88. Okay, so this is say we're able to do this consistently each time. This is best for math. Okay, so just to math in terms of understanding. Anyways, running out of time. But in short, 15 wins. Okay, because the reward to risk ratio is so good, 132,000. Even though you have a lot more losses, it's a lot less. So you still see a net profit of 76,000. Anyways, gotta go check out RAIDER12. Okay, That's it. Links below or click the add to cart button. Thanks.